This is not financial advice. I'm recording my thoughts about Ulta Beauty stock. The stock is down about 13% in the past 5 days and it is currently trading at about $427. In this video, we're going to talk about why the stock is down and whether this is a good entry point. Ulta Beauty, as we know, is a beauty products retailer. As you can see on the screen, almost 44% of their sales are in the cosmetics, 20% in the skincare and 20% in the hair care. And they also have about 4% of their revenue coming from the services business. Let's now look at why the stock is down after the recent quarter earnings. As you can see on the screen, in the most recent quarter, they made about $2.6 billion of revenue. The gross profit margin was about 40%, which is healthy for a retailer. And the net profit margin was about 13.2%, but it actually has dropped year on year. Earlier, it used to be 14.1%, and now it dropped by almost 1% to 13.2%. They made about $347 million net income this quarter. In addition, for the guidance for entire year of financial year of 2023, they are saying that the operating margin is going to fall from 14.7% to about 14.5%, and the guidance did not change. They are still on track to make about $11 billion of revenue in the entire year of 2023, which only represents about 9% year-on-year growth. This company was growing in the double digits, like early double digits in the past few years, and now they're saying they can grow at about 9% year-on-year. And they also have highlighted that they're going to have a capital expenditure of about $400 million because this is a beauty retailer. They have to open new stores across the United States, and that's going to cost money. So this is a capital intensive business, and therefore they're saying they will spend about $400 million in capital expenditures. That's going to hit the bottom line, as we all know. Let's now look at whether this is a good investment at this point or not. With respect to cash and cash equivalents, they have about $636 million of cash, which is healthy because they're already profitable. And on top of that, they are buying back shares. As you can see on the screen, they have about 52 million outstanding shares last year, and this year they only have about 50 million. That's almost 4% buyback. If you look at Ulta's valuation, I'm going to give two cases, one with reasonable assumptions and the other with great execution. In the reasonable assumptions case, I'm assuming that they can get to $11.1 billion this year, like they have guided. I'm assuming a revenue growth rate of 8% year on year. In the most recent year, they are saying they can grow about 9%, right? But when the macroeconomic environment gets better, it has to improve. But 8% I think is reasonable. With that, they can make about $15 billion of revenue in 2027. Current net profit margin is about 13.2%, and I think they can easily achieve 14% as the scale. And with that, they will have about $2 billion of net income in 2027. This is a slow growing company with under 15% net profit margins, and this is a large company. So I'm going to give a cash cow multiple of 15. Think about it, when I assume a multiple of 15 for this kind of business, we'll get all our money back within 10 years. And I'll probably explain that in another video, but for now I'm assuming a cash cow multiple of 15, with which this company would be worth about $31 billion. With respect to the number of outstanding shares, currently they have about 50.4 million outstanding shares, and I'm assuming 1.5% buyback in the next few years. Remember that this company makes about $1 billion of net income, and they also have a capital expenditure. This year they're saying they will have a capital expenditure of almost $400 million, but if it continues, then 1.5% buyback is reasonable. But if they do not spend that much in the coming years, they can do a higher buyback. Remember that they did 4% buyback in the recent year, right? But 1.5% seems reasonable to me. With that, they will have 47 million outstanding shares in 2027. When I divide the 31 billion market cap with 47 million outstanding shares, I get a share price of about $666 in 2027. But currently they're at $427, right? So that's about 56% gain, which is decent. Remember that these are reasonable assumptions. They can grow faster than 8% year on year, and they can get a higher multiple. Current multiple is close to 20, right? So they can get a multiple better than 15, and I'm assuming 1.5% buyback. They could do more, but this is a reasonable assumptions case. So I think 56% is decent. It's going to beat the market. But let's look at the great execution case now. In the great execution case, I'm assuming 10% growth rate. With respect to net profit margin, I'm assuming 15%. In the reasonable case, I assumed 14%. and I'm giving a multiple of 17.5. With that, this company would be worth about $913 in 2027. Currently they're at $427, so that's about 114%, which makes it an attractive gain. 114% gain is very attractive. In conclusion, we're looking at a 56% gain in the reasonable assumptions case and about 114% gain in the great execution case. Overall, I think I'm neutral on this stock. If someone wants to buy at this price, I don't think it's a bad buy. But for me, I would wait for even a better entry price. If it goes below $400, then I'm definitely going to buy this stock. Let me know your thoughts in the comments. Thank you so much for watching.